During the 2008 financial crash, institutional trading desks didn't lose sleep over falling stock prices. They panicked over something else entirely: fixed operational liquidity. When cash flow dries up overnight, debt obligations stay exactly the same size. I spent years on institutional trading floors watching how major funds survive brutal market meltdowns. The secret isn't hoarding millions. It is structural minimalism. Today, you will learn 7 insider habits that strip away financial drag and keep you completely safe during any economic storm. Let's look at a realistic scenario. Meet Marcus. He's 34 years old, working as a mid-level project manager in Chicago. He earns $85,000 a year. On paper, Marcus feels comfortable and secure. He takes home roughly $5,200 a month after taxes. But let me show you where his money actually goes. Marcus pays $2,200 a month for a modern downtown apartment. He pays $450 for a leased sedan, plus another $150 for auto insurance. He spends $800 a month dining out and ordering delivery. He carries $400 in monthly credit card minimum payments, $200 on subscriptions and memberships, and $600 on groceries and utilities. After all these expenses, Marcus has just $400 left over each month. He believes he is doing well because his lifestyle matches his peers. But according to a survey published by the Federal Reserve, 37% of American adults cannot cover an unexpected $400 emergency with cash. Marcus is living on the edge of a cliff. He is one corporate layoff or income disruption away from total financial disaster. He doesn't realize it yet, but his high-income life is built on fragile debt and zero margin for error. When an economic downturn strikes, market conditions change rapidly. Corporate revenues drop. Companies freeze hiring and quietly begin cutting staff. But your personal financial obligations do not adapt to macroeconomics. Your rent remains $2,200. Your car lease remains $450. Your minimum debt payments remain completely unchanged. Most people believe earning a higher salary is the ultimate defense against an economic crisis. That is a dangerous myth. Income is variable and uncertain. Overhead is fixed and relentless unless you deliberately restructure it. This brings us to our first minimalist habit: capping your baseline fixed burn rate. On Wall Street trading desks, we refer to this as the fixed cost ratio. In plain terms, your fixed cost ratio is the exact percentage of your take-home pay required to pay for non-negotiable survival expenses every single month. That includes basic shelter, basic utilities, core groceries, and minimum debt commitments. Currently, Marcus spends over 85% of his take-home income on fixed obligations and recurring habits. If his company cuts his salary by 15% or eliminates his annual bonus, he immediately enters a monthly cash deficit. Institutional investors survive market crashes because they cap their fixed costs at under 35% of baseline income. They intentionally structure their lives below their financial baseline, never at their maximum income ceiling. If housing and fixed debt swallow the majority of your check, you are carrying massive systemic risk. Lowering your fixed overhead provides immediate, structural resilience when economic conditions turn negative. Now let's examine why most middle-class professionals fail to lower their monthly burn rate. Modern consumer economics is explicitly designed to capture your excess cash flow. Every time your career advances and your salary rises, subtle cultural expectations push you to increase your living expenses. According to a research study by the Consumer Financial Protection Bureau, over 60% of middle-class professionals earning above $75,000 annually experience severe lifestyle inflation within 6 months of receiving a salary increase. Lifestyle inflation simply means increasing your consumption at the exact same pace as your rising income. This leads directly to the second minimalist habit: decoupling your personal identity from consumer spending. During my years on institutional trading floors, I noticed a striking pattern among senior money managers. The individuals who survived multiple market cycles rarely drove hypercars or wore conspicuous designer clothing. They drove modest, decade-old sedans and wore simple, functional clothes. They understood a fundamental financial truth: genuine wealth is what you cannot see. Wealth is liquid capital, accumulating compound interest, not expensive depreciating assets parked outside your home. When you stop spending money to signal success to colleagues and neighbors, your fixed monthly expenses fall dramatically. That saved capital becomes your primary shield when corporate restructuring begins. Let's talk about silent financial leaks. Individual recurring transactions appear harmless when viewed in isolation. A $12 streaming subscription, a $50 monthly gym membership you rarely visit, a $10 cloud storage fee, a $6 daily specialty coffee purchase. A national study conducted by CNO Financial Group revealed that consumers underestimate their monthly recurring subscription spending by an average of $219 every single month. That represents over $2,600 of liquid capital leaking silently off your balance sheet every year. This brings us to the third habit, relentless capital pruning. Every quarter, corporate chief financial officers conduct rigorous line item audits. They examine every single corporate expense to eliminate unnecessary operational weight. You must apply this exact corporate discipline to your personal bank accounts. Print out your bank and credit card statements from the last 90 days. Take a highlighter and mark every automated recurring payment. Ask yourself one critical question. Does this expense directly preserve my health, my safety, or my ability to earn income? If the answer is no, terminate the service immediately. Saving $200 a month during an economic expansion might feel insignificant, but during a severe recession, that represents thousands of dollars in pure cash reserves under your direct control. Here's the major twist that conventional personal finance experts rarely discuss. When economic danger looms, standard financial advice instructs you to cut out small daily pleasures and hoard every available dollar inside a standard checking account. However, during major economic contractions, central banking authorities routinely lower interest rates and inject liquidity into financial markets. This policy response often triggers unexpected inflationary spikes. If you keep all your reserve cash in traditional checking accounts, your purchasing power steadily erodes every single month. Furthermore, hoarding liquid cash while carrying high-interest debt creates an invisible financial trap. If you maintain $5,000 in cash, earning zero interest, while carrying $5,000 in credit card balances at 23% interest, you are actively destroying your personal wealth. The true objective during an economic downturn is not blind cash hoarding. The true objective is eliminating financial friction and optimizing capital efficiency. This realization brings us directly to our fourth minimalist habit, building a three-tiered liquidity ladder. Liquidity refers to how quickly an asset can be converted into spendable currency without suffering a loss in value. Most average households maintain their assets in two dangerous extremes: low-interest checking accounts or locked retirement vehicles. This creates severe operational risk. If you experience unexpected job loss, your checking balance vanishes quickly, while withdrawing funds from retirement accounts incurs steep tax penalties and early withdrawal fees. An institutional approach requires dividing your liquidity into three distinct operational tiers. Tier 1 consists of your primary checking account, holding exactly 1 month of lean operational expenses to manage daily bills. Tier 2 is a dedicated high-yield savings account, holding 3 to 6 months of baseline survival expenses. This capital stays entirely liquid while capturing real interest yields. Tier 3 consists of short-term government instruments, such as 3-month treasury bills or money market funds. According to official banking statistics from the Federal Deposit Insurance Corporation, tens of millions of account holders leave emergency funds in traditional commercial banks earning under 0.05% annual interest. By deploying a three-tiered liquidity structure, your safety reserves actively combat inflation while remaining immediately accessible during economic emergencies. Look at how average households manage debt during prosperous times. They maintain multiple credit card balances, an auto loan, personal consolidation loans, and several buy now pay later arrangements across various merchant apps. This brings us to the fifth minimalist habit, liability monotasking. When your liabilities are fragmented across numerous financial institutions, psychological fatigue builds rapidly. You are forced to track multiple due dates, varying interest rates, and separate minimum monthly payments. During corporate workout scenarios, distress managers focus heavily on capital simplification. They immediately restructure complex obligations into single, clear liabilities. You must simplify your debt obligations long before an economic crisis hits. Focus on completely eliminating smaller balance debts first, regardless of slight interest rate variations. This systematic approach reduces the total number of monthly bills you owe. Fewer monthly bills mean fewer operational points of failure. If your household income experiences a sudden shock, managing 2 monthly obligations is far more manageable than coordinating 10. Why do most working professionals struggle to curb spending, even when they recognize an economic downturn is imminent? The cause is engineered consumer frictionlessness. E-commerce platforms spend millions of dollars analyzing consumer psychology. Innovations like one-click purchasing and auto-filled payment details exist exclusively to remove cognitive friction between desire and purchase. This leads to our sixth minimalist habit, implementing a mandatory 72-hour friction buffer. A study published by the Stanford Center on Longevity found that delaying non-essential purchases for 72 hours reduces impulsive buying behavior by more than 70%. Whenever you feel the urge to buy a non-essential item online, add it to a digital cart and enforce a strict 3-day waiting period. Take active measures to reintroduce physical friction into your spending. Delete saved credit card profiles from online browsers and shopping applications. Forcing yourself to retrieve your physical card and manually input your card numbers interrupts instant emotional gratification. It shifts purchasing decisions from rapid emotional impulses to calm, rational assessment. Finally, we arrive at the most vital habit for surviving any major economic crisis: professional skill minimalism. When a recession deepens, corporate executives perform ruthless talent audits. Workers who hold broad, non-specialized skill sets are often selected for immediate workforce reductions. According to historical labor statistics from the Bureau of Labor Statistics during past recessions, specialized technical personnel and direct revenue-generating roles suffered significantly lower layoff rates compared to general administrative staff. The seventh habit is developing portable, recession-proof core capabilities. Rather than dividing your energy across multiple fragile side hustles, focus intensely on mastering 1 or 2 high-leverage skills that businesses require for survival during downturns. Capabilities like direct revenue acquisition, technical system maintenance, or specialized financial analysis are non-negotiable for struggling firms. When you streamline your professional focus around essential, high-demand skills, you make yourself structurally indispensable while broader unemployment rises. Let's bust the single biggest myth surrounding economic downturns and minimalist living. Most people believe surviving a financial crisis requires severe self-deprivation, living on minimal rations, and relinquishing every comfort in life. They view crisis preparation as a miserable exercise in forced sacrifice. That perception is entirely false. Effective financial minimalism is not about deprivation. It is about total operational efficiency. When you eliminate artificial lifestyle bloat, lower your fixed cost ratio, and establish a structured liquidity model, you don't feel restricted. You experience complete financial freedom. While average consumers panic over mounting debts and economic uncertainty, you operate with absolute confidence and structural security. At the core of the economy, market downturns are not unpredictable surprises. They are natural, inevitable phases of the broader business cycle. You cannot control central bank policies, stock market volatility, or corporate downsizing, but you maintain absolute control over your personal overhead and financial friction. Remember those institutional trading desks during market crashes? They survived because their risk models were lean long before the storm arrived. Keep in mind, this video is created strictly for educational and informational purposes and does not constitute individual financial advice. If you want to master your personal finances and build lasting security, hit the subscribe button. Leave a comment below telling us which minimalist habit you are adopting today.